Good morning all and welcome to this morning's video. So this morning I have two pairs on watch and those are dollar yen and CAD Swiss. So I've got quite a bit of time to break down these two pairs. So I'm going to start off with my favorite of the bunch, which is dollar yen, and we start off on the daily chart. As I said yesterday, I'm going to try and start from the daily chart just because starting from the weekly chart and the monthly sometimes takes a little bit too long in these videos. So it's not that I haven't done top down analysis from the monthly downwards at the weekends, but just to keep these videos a little bit more concise, I'm going to start from the daily the majority of the time, unless something is particularly relevant on the weekly or the monthly. And without further ado, let's break this down. So dollar yen, this is about as simple as it gets, really. If we just look at this, we have this high here where there was a big sell-off last time around. We near missed that high, actually. Just looking at this, we have a near miss to that high, so it doesn't surprise me that we come back up. We tap the high, but we don't break above. And you might be thinking, if you're new to this way of trading, but surely that's a double top. It is a double top, but what we typically see on the higher time frames, and in particular when we have such a standout high like this, if we just look left, according to my data at least, this is an all-time high. I think I saw in someone else's data that this is not an all-time high if you go back far enough, but certainly according to my data it is. And the more significant the high, typically speaking, we tend to break above the high before we see the bigger moves to the downside rather than just tapping into it. Okay, tapping into it and getting a bigger move is typically something we see more so on the lower time frames. Okay, and the clue for me that we would likely come back up to break above this high before the longer term move to the downside is the fact of how price was actually moving, how price actually moved down from that area. If you look, okay, we have the all the way down, we have these sharp pullback there, sharp pullback, very sharp pullback here, another one here, and then we tap into, okay, we tap just below this sharp move. So often these sharp moves are an indication of volume, either volume being placed in an area or volume which is dragging price back up. Okay, so we tap below there. We do so in the form of a reversal structure, and then once that liquidity was taken out, it's likely you see how price moved. It moved in a very direct manner, suggesting that these sharp pullbacks, this direct move, are partly caused by the fact that there's still liquidity above here and liquidity being placed in this area, which is dragging price up, which needs to be filled before that longer term move to the downside can occur. Okay, so as I said, I'm just trying to go into a bit more detail just because I have more pairs, more time to break down these pairs. Okay, because of the fact that I only have a couple on watch. Okay, and the clue for me that we may break the high and push to the downside is that we have a near miss to here. Okay, we have a near miss to here, so we're getting these structural moves up. Okay, so when we see these structural moves up, doesn't have to be exact, but you can see first drive, second drive, we may break above, and this may be the third drive, which takes us down to take out this near miss to that low. Okay, so these near misses and these structural moves are also a clue that we could be headed lower. So as I zoom into the next piece of the puzzle, okay, if we just look at this, so we have consolidation. We're stalling at an area of value. Okay, now what I was anticipating when I saw this, once again, we tap the area, but we don't really break above. We come back up, we tap the area again, but we don't really break above. So when we started to sell off from here, okay, I was under the impression that what would likely happen, again, we don't know what's going to happen in trading. We can only surmise based on the patterns that we look for and the patterns that we've seen in the past play out. I thought that we'd likely break below this area of consolidation, likely wick below it, and then wick back up, because not only would we have tapped out a lot of the stop loss orders that were just below, we would have also been retesting the back end of this volume here. So once that liquidity was tapped out, that would likely cause price to move to the upside to potentially break this high, these highs which we keep failing to break above. Okay, and that is exactly what has happened. Okay, so we can see we have this green candle with a big wick below it. That is a very big clue that we're moving to the upside to break that higher time frame high. And if you just look at these candles, at least at this moment in time, we have a green candle, a smaller green candle, and a green candle which is even smaller. So by definition, this implies that the market is running out of steam at an area value where I would expect it to run out of steam at. Okay, if that makes sense. A big thank you to the new subscribers, by the way, before I forget about to mention this, that have subscribed to my channel in the last, my YouTube channel. This is being this video is available on several platforms, but in the last 24 hours, I think we've got another 500 subscribers. So much appreciated if you're one of those people. So I wouldn't be surprised. You can see these wicks here. That's a big clue. I'm just literally just assessing what I'm seeing on the fly here. Okay, with these big wicks, all these big wicks below price are implying that liquidity is being grabbed, and that we will likely, the liquidity that has been grabbed will likely cause price, now that it's off the table, to break above that higher time frame high. Okay, we have another near miss there, a near miss to these previous highs. These are all to some extent FOMO legs. So people start selling too early, knowing that they're supposed to wait for it to get to here or to here. So there's a lot of FOMO in there. So with all of this in mind, what I'll be looking for, if we just, I'm just going to take off that higher time frame high for a minute, just to make it a bit more simple. And now you can see we're still in that overall area of value, but we can see the near miss to that high, near miss to that high. As I said, this is largely FOMO. There's many psychological aspects of the way that those of us who trade the Falcon strategy trade, but FOMO is probably one of the most easiest ones to actually identify. Okay, just because price gets near to an area, doesn't quite get there, and then you get these little fake sell-offs. Okay, so what I'll be looking for is, you can see my minimum entry requirements here. I'll be looking for a tap into the area of value, so the area of value being there. Okay, and then I'll be looking for, as I said, it will likely break above, but if we tap into that area, we push back down and we get a 1 hour impulse down below our area of interest, so below this high here. Okay, if we do break below the area of value after we've tapped it, because they're so close, we'll likely tap below here as well. If we get the 2-touch 5-minute continuation, so 6 to 8 corrective 5-minute candles, which is usually just the banks and the big institutions stacking their orders for the next wave to the downside, then I would look to get short with what we call a reduced risk entry on the break of the consolidation. And I don't think this holds much weight. One, because it's not a sharp move. Okay, that's the main reason. And especially if we've just broken above and tapped back in, it's likely that this won't hold much weight at all. But even then, I would be able to manage it down to that low for something in the region of 1.2%, 1.3. My first target would be there. Okay, so if we got the 5-minute, the 2-touch 5-minute continuation, I'd take the reduced risk entry on the break. If we got a 2-touch 15-minute continuation, which is 6 to 8 corrective 15-minute candles, then I would do the same thing, look for the entry on the break, but I would also be simultaneously looking for the entry within the flag once we've got the two bottoms. Okay, and I would have a minimum 10 pip stop loss, and I'd be looking for price to tap the initial high and reject from it by way of either a retrace candle or a pin bar, so a high test. And then the first solid target for me would be here, because we have a sharp move. We have a sharp move down followed by a sharp move up, which just so happens to retest the previous correction and kind of retest all of this volume that was sat there. So that would be my first solid target, where I would be looking, where price could consolidate for a little bit longer, and I'll be able to manage the trade down to that area for something in the region of 4.5%. And then, of course, if we just move that over a second, where I would be looking to get out, and say it's not necessarily that price would stop and reverse in that area, but if you look at the sharpness of this move here, which was the causation, which was the, I forget the word now, the inception, that's the word I was looking for. The inception of this move here was here. Okay, so that it would be, even if price did continue to the downside, okay, to take out perhaps this low, okay, that would be where I would anticipate a lot of people getting out of their positions, okay, people taking profit, okay. So what I would do with that in mind is I would measure from range to range. So I would measure from range to range. The 90% area of a range is often where price pulls back to about 50% of the move, and we get these kind of larger consolidations like that. Price can pull back like that before it moves in our forecasted direction. Now, if that was to happen, I would be giving back potentially about 4%, 4 or 5% of this move, with no guarantee that price would then continue in the forecasted direction anyway, because the wider this got, it could be what we call an M style pattern, where then price starts to pull back and test the highs again. So I don't want to sit through all of this consolidation, which can sometimes take as long as, let's say, a week to play out, even if it does play out. So what I would do is I would set a take profit at the 90% area while simultaneously trailing my stop loss. And then that would give me something in the region of, you can see there, 9.5% to work with. So that looks very nice indeed. So that is a lower risk position. Okay, the questions I ask myself, I'm going to put it on the chart just seeing as I have more time. This is what I do at the weekends. I ask myself, am I well positioned for a move to the downside? Okay, so we just take that off the chart. Yes, I would be well positioned for a move to the downside on the higher time frames. Would I be well positioned for a move to the downside on the lower time frames? The answer is yes. What would the sequence look like? Well, if we got this, it would be the first flag in the sequence to the downside. Okay, so by definition, the sequence would look good because there wouldn't have been any previous corrections for me to be able to gauge the sequence of corrections on the way to the downside, if that makes sense. If the market was to take me out, why would it do it? Well, why would it do it? Because there's nothing to the left. There's no inflection points or value areas above price that price could gravitate towards. So therefore, I can't see any logical reason why the market would take me out. And so, where is it going to? If I got tagged in and tagged out of this position, where is price actually going to if we've already tapped that area and moved to the downside? I can't think of a reason. So there's no logical reason. So therefore, this is a lower risk position. Okay. So that's how I come to that conclusion. So I'm going to put that in the box, and I'm going to do the same thing again in a minute with the next pair. So I've put a little green tag on this pair to denote that that is a lower risk position. CAD Swiss is a slightly different entity. So previously, at the start of the week, I was looking for price to form some kind of continuation below here and retest all of this volume, okay? But the little clue for me that price may come up to test these highs or do something more complex is these wicks. So when you have a correction, even if it was to form like this, when you have a correction which is formed by these big wicks to start with, that in itself is a clue that this correction may be less reliable, or that price is moving up to the next inflection point, okay? Because it implies that liquidity was grabbed from somewhere, okay? So if I just zoom out a little bit, one of the reasons this is lower down on my list, so I'm looking to get short on this pair, but one of the reasons this is lower down on my list is because if you just zoom out, it's important to zoom right out, you can see that we've broken all-time lows, okay? So this is where the bigger players would be getting out, as I often say, bargain area of value for a move to the upside. However, it doesn't mean to say that we can't capitalize on a shorter term move to the downside in the meantime. It just means we have to be aware that we are trading short after, we've just tapped out, we've just broken below and then retraced back above an all-time low. So longer term, this is where the bigger players would be getting in their positions for a move to the upside, okay? So just being aware of that. Okay. So if we just zoom out to the downside, you can see we have tapped into this area here, this area of consolidation where there was a big run off to the downside, suggesting there may be a lot of liquidity there. And we do break above, catch people the wrong side of the market and push to the downside. However, there is also an area of consolidation here where there was a sharp move to the downside as well. Okay, and you can see that we've kind of near missed to that area. Okay, so one of the reasons, typically speaking, one of the reasons that we're getting such a large correction so early on into this move is perhaps because this is a middle section to take out that low, to then push up to there, to take out the high that we near missed to then push to the downside, okay, which would give us more of this structure, okay, and more of this expanding pattern where we have kind of higher highs when the trend lines are kind of, if we were to plot trend lines, moving further apart. So that is often why we see larger corrections so high up in a run, because it often implies that we're going to move to the downside and move to the upside. Or sometimes this gets so wide that we get that M style pattern where we just break out to the upside. So already this is increasing the risk of the trade. Okay, so I've got to speed up just a little bit here. So you can see that we tapped above this area. We then got this tight correction here, which looked like a healthy correction, and I was looking for the consolidation below there. You can see that we're now near missing to this area, giving me a clue that this potentially is an area of value when we see these near misses. So what I'll be looking for on this pair is I'll be looking for price to tap into this area. I'll be looking for a 1 hour impulse down below the area of value, and then just because this is slightly higher risk, I won't be looking for a two-touch 5-minute continuation. I'll be looking for a slightly more deliberacy, which will be a 15-minute continuation, so 6 to 8 corrective 5-minute candles, and then I would be looking for that entry on the break and also simultaneously the entry within the flag, and then I should be able to manage it down to here for something in the region of 4.5%. And then my target where I'll be looking to get out would be here for something in the region of 7.5%, because if we just measure this move, okay, if we assume that that's where the impulse started, so impulse correction continuation, and we assume that the continuation leg out is of a similar length, that would take us to just below here where I would anticipate we potentially tap out of the orders and then move to the upside, and then this becomes the middle section within this structure to take out that high that we near missed to, okay, that I showed you a moment ago. So the question I asked myself with a couple of minutes left of this video is, and I would use the mechanical management tool again, just to touch on it to manage that trade. Am I well positioned for a move to the downside? Okay. Well, yes, because we've tapped above here, we've moved to the downside, and I'm just seeing this as an impulse correction continuation to take us down to there. Okay, am I? We can see that we have broken back above these highs, but typically speaking, I'm well positioned for a move to the downside. Am I well positioned on the lower time frame? Well, yes, I can see this on the 4-hour chart. Little tap above here, move to the downside. What does the sequence look like? Well, the sequence looks healthy to me. We have this little tight correction here, which doesn't pull back more than 50% of the initial move. You can see that more clearly on the 15-minute chart. We have this correction here, which doesn't pull back more than about 50%. We've now pulled back about 60%, but as I've mentioned previously, with more corrective pairs, price does often pull back about 60%. So I'm satisfied that the sequence is fine. If the market was to take me out, why would it do so? Well, why it would likely do so is because it's trying to find liquidity from this area sat above this high near miss too. So, okay, based on the if the market did take me out, what would it look like? Well, it may tag me in, tag me out, and do something like this, and then move to the upside to take out that high. Does that look abnormal to me? No, it doesn't look abnormal to me. And because that doesn't look abnormal to me, this is a higher risk position. That's how I gauge my positions. So there you go, HR, higher risk. So therefore, my rules dictate that I don't take higher risk positions unless I'm in profit by 2% for the month. And since I haven't placed any trades this month, I'm still at break even. Therefore, I would not take this position unless dollar yen or one of the other pairs that I have in my other watch lists was to shape up. I've just got, this is my main focus, but I would have to be in profit by 2% for the month before I was able to take a position on CAD Swiss. So that is how you treat trading like a business. I have a plan for every scenario, okay? And unless my plans are met, then I do not place a trade. And that's how we need to treat trading, and that's how you're going to scale your capital long term and not blow your account like many of the amateurs are doing. Thanks for watching, folks. I hope you've taken some value from this, and I'll see you again in the next video. Adios.